Well, I'm delighted today to be speaking to Thomas Muir, founder of APG Capital. We're here at Old Government House in Guernsey. We're going to be talking NorthWest real estate and why it's an exciting opportunity for private investors. Welcome, Thomas.
Thank you, David.
Tell us a little bit more about APG Capital, the business you founded.
Yeah, so APG Capital is a real estate development company. As I say, we're based in the NorthWest, and we very much focus on residential apartment blocks in and around Liverpool and Manchester and those sort of key areas in the NorthWest. I've been in property for 15 years and generally grew the business from sort of small buy-to-let properties to doing the larger scale developments.
Great, and tell us a little bit about your team. I mean, who supports you in delivering these investments?
So yeah, fortunately we have an in-house construction setup. They're all the strong profiles, and they've all come from tier one contractors. But we've enabled that setup to be flexible. We like the flexibility of having control over the projects, and I think that's key. Rather than being at the mercy of a third party, we have control from the start to the finish. So.
And that helps you drive returns, doesn't it? Because having control of the projects, the team you've got to deliver to a standard, gives you something more predictable to take to investors.
Absolutely, yeah. So obviously, when we're working with investors and managing client money, it's important that we control all the facets, and we take the risk out of each point, and controlling the construction is one of those risks.
And how would you describe some of your USPs or other alternatives to your offering? How would you contrast yourself to others?
I think from an investor and a client perspective, I think being direct to the developer is a big thing. It's a personal relationship, and that we like to take the investor on the journey with us throughout the project. So typically, it's an opportunity for an investor to be involved in a project without the all the challenges and the hassles that go on in terms of delivering the actual scheme.
And they remain in close contact with you throughout the project, so things don't drift. They feel well informed. There's not layers and layers of bureaucracy for them to get through in order to understand the investment.
Yeah, absolutely. We try and make things as simple as possible, and we lean very heavily on sort of the bank and their monitoring and their the criteria that they have. A typical mantra would be if a well-established bank funds it, then it's a good deal.
Yeah.
We use their reports, their RICS reports and stuff to give the investors confidence throughout the project.
Okay, great. And just zooming out, I mean, there's a lot of buzz about NorthWest real estate when I talk to international investors and their advisors from everywhere, from the UK to the Channel Islands where we are now, to further afield, the Middle East, Far East. What is it you think at the moment makes the NorthWest real estate a good sort of buying opportunity?
Yeah, I think the NorthWest has always been a bit of a hot ticket in terms of real estate. I think when you look at the buy-to-let charts and the highest yield, it's always, the NorthWest is always in there, whether that's Liverpool or Manchester or other places. And I think from an international perspective, the yield is there. It's an attractive area. It's still growing. And I think, the London thing, obviously, there's low yield in London, so it's very different. So I think there's that, but there's also there's still a buzz in the areas. There's still a lot of growth, and there's also institutional capital being deployed into the city centres, big build to rent schemes. So there's still a lot of buzz, despite maybe the economy being in a bit of a lull at the moment.
How would you break down the different parts of the markets? Obviously, Manchester different to Liverpool, different to Leeds. I mean, you might call Leeds northeast. So it's like how do you characterise that corridor? I guess that people might lump together in one group, when obviously it's got there's lots of different characteristics of different markets there.
Definitely very different, and I think from an investor perspective, if we start with the yield and return, typically those three main cities that you've mentioned, they'd be there or thereabouts in terms of being return. Obviously, there's different. Manchester's a market that's boomed, if you like, and I think personally will continue to grow. Leeds has probably grew a little bit under Manchester, and I'd say Liverpool is probably third in that league, but with plenty of potential. So in terms of potential for growth and yield, they're there or thereabouts, but they're all at different stages.
And knowing those markets inside out will help you work with investors to avoid getting it wrong, buying in the wrong place, because it's not a uniform market. You'll notice the characteristics of, oh, this will be a good asset because it's got the right bit of infrastructure nearby, or those sort of details is where you can earn your money, isn't it?
I think definitely local knowledge is a big thing. You want to know the areas that are growing. You probably want to know the areas to avoid. And, you've obviously got to have a good handle on value. So that local point is very important.
And in the residential market, I mean, like the student market is quite big on, the commercial blocks and different but young professionals. I mean, how do you see, like, when you're looking at bringing an asset or bringing something new to market, how do you consider some of these factors, particularly in key cities like Manchester and Liverpool? Yeah,
the student thing in those areas is very important, especially for retention once they finish the courses and go onto other areas. But I think, both cities have growing universities. I think Liverpool's actually got three big universities in it. So I think, it's very important for that the next stage of their lives is in the city where they've studied.
And do you think that the sports and the media side in Manchester, there's a lot of a spotlight on the cities actually across the Northwest, isn't there? Yeah. Through many channels. Do you think that helps your job? Because actually, if you're looking at foreign investors, there's a familiarity there with some of the key cities as brands.
Yeah, definitely. I think Liverpool and Manchester both have strong international names, and it makes my life a lot easier actually when people may hear me talk, may hear my accent, and say, "Oh, you're from Liverpool." And there's also there's a connection there, whether it's through football or music. I think both of those cities attract international interest, but obviously then there's a commonality, and you can lead that into business success as well. Because
the city centres of Manchester and Liverpool have changed dramatically, haven't they, in recent years?
Yeah.
Is there more development to come? Is there more of as someone being close to it? Do you see that those developments of, if you take Spinningfields in Manchester, it's fantastic, but it's like, where's the next place that's coming through?
Yeah.
That when you spin it on a few years, you'll see as, oh wow, more things springing up.
I think Manchester, just on its own, in my opinion, it's a bit of a mini London, the growth that's been experienced there. But it continues to grow. It doesn't show no sign of stopping. There's continued development, continued demand for businesses moving into the area, and obviously residents as well. So, and Liverpool's the same, albeit a little bit further behind, but in terms of growth, there's a lot of development, there's a lot of new development schemes, there's businesses moving into the area, and I think both of them core cities still have room to grow. It's not at the peak yet.
Absolutely. And how can, if investors are sold on the investment case, how can they participate in some of the opportunities that you bring to market? What does it look like when they want to pull the trigger on something new that you're bringing to market?
So we'll identify a scheme or a project that we believe is good to move forward within our criteria, and then from an investor perspective, we would offer the opportunity for them to participate on an equity basis. So they would, in terms of the funding required to deliver the scheme, we would work with a senior lender provider. And then the balance of the funds needed will be made up from our own contributions, our own skin in the game, and the investor would input capital and be part of that project until we exit at the end.
And the typical time horizon on these, it varies, but what might a typical project be in terms of when that investor might see proceeds on a return?
I think a typical timescale is 18 months. It all depends on the exit. So we do generally try and tie the exit up early with some of our investment partners who buy finished stock, whether that's direct to a fund or a consortium, but typically on a timescale it would take 18 months.
And you have a part of the strategy is to have a clear exit plan to go into that's a key part of the case, isn't it? And how investors are going to get out of the opportunity is just as important, isn't it?
Yeah, 100%. Yeah. And every deal we do, we start with the end in mind. The exit is the most important thing. And that's typically identifying, somebody who wants to invest in a building at the end. When we'll get them tied up as early as possible. We'll do a deal, and then our job is to fund it and build it out. So, very much exit in mind.
And in terms of sort of risk management for investors, there's obviously a lot of DIY approaches in residential property. People feel they can, I could just but they see something on Rightmove they want to buy, put a team in to develop. How can you provide something that's just more efficient and more managed than a DIY approach? If you're dealing with someone who's interested in expanding their allocation to assets in the Northwest, how do you contrast what you're doing and where they might go wrong if they do it themselves?
I think again back to the local knowledge point of view in terms of supply chain. Whether that's contractors or dealing with professionals, but again, knowing those local values in terms of is the end value what we think it's going to be? Is the sum that we've put in the appraisal for construction, is that what are the variables in there? So I think with ourselves, obviously we're doing 4 or 5 projects at the same time.
Yeah,
we've constantly got a live data feed of what's happening in the market of finance, construction, and exit.
And you quite often work with ex-property guys who've been through the mill, as it were, done the developments, and now they invest with you alongside because they know that you can go and deliver that project. So that's a great accolade, isn't it? That industry insiders, if you like, vote with their feet and invest alongside you.
Definitely, yeah. I think it's in our sort of investor profile, we have noticed that a lot of the people that we work with have been involved in property previously. They understand the game and they understand what's required, but then also they may not want to be involved in those daily operational challenges, and they see this as an opportunity to still access a project, still get a great return, be part of that story of creating a building that's a bit of a legacy play, but ultimately the hands off and somebody else is dealing with the headache, so to speak.
And we've seen interest rates now at much higher levels than they were previously. Obviously, bank debt is part of the mix on these developments, but how does the hike in interest rates affect some of the projects you're looking for? Do some things become less viable because now the financing position has changed, or are the projects you're working on actually there's enough margin there that even with higher interest cost, you're still very positive?
Yeah, so a lot of the stuff we're involved in at the moment is on sort of fixed interest, so we that hasn't really been affected by the variable changes. But again, going into an appraisal, it's it's very important that the new rates and the new way of working is factored in. We're just coming off that a little bit. That then's obviously going to come off the land value and what we're paying. So again, in terms of local knowledge, it's really important to have all of those key live data of what it's actually costing at the minute to deliver the scheme. But in terms of interest rates in general, you've got that side of it, the development finance, but then there's the buying side. And obviously we're seeing a little bit of a slowdown in the owner occupier market at the moment. So our exits are generally cash purchase exits, again de-risking that area.
Okay, great. And could you perhaps talk us through a kind of project that you've previously exited, so to kind of give a sense of what a full investment cycle looks like?
Yeah, absolutely. Yeah. So we recently completed a project called Park Terrace. It was 28 apartments. It was based in North Liverpool, and it was a derelict building. It already had planning in place for reconfiguration, a little bit of new build extension, but mainly restoration of the old building. It was in a conservation area, and a lot of the stuff that we do, not specifically, but I've done sort of grade 1, grade 2. I really love restoring these old buildings. But from an investment perspective, we took that on. We brought the bank debt in, and then we brought the investors in on a fixed interest basis. We completed the project. That project actually took us in both phases 15 months. But we exchanged with the investors, the buyers, very early on. So our overall cycle was 18 months of arranging the senior debt, investors putting their capital in, us completing the project and exiting in this summer. So
fantastic result. Yeah. And you have been getting involved in some of our networking events with the intermediaries that we have as part of PCD, but it'd be great to hear a little bit more about the kind of intermediaries that you work with, different styles of professional contacts that might be good partners for you. So
typically we work with IFAs and wealth managers who, in their client base, we can offer them something that's a little bit different. than a sort of standard, fixed rate bond or fund investment. And we can do that on a commercial and fiduciary basis. Alternatively, we can work with lawyers and tax advisors, again, offering their clients something a little bit different, something that isn't sort of in the mainstream market, and that can be on a reciprocal basis of bringing business both ways.
Great. And you're coming out with us to Dubai in November. We've got a large networking event there. I mean, do you see the Middle East as an important market for investors coming back into the UK?
Yeah, I'm very interested to see how that plays out. I haven't got loads of expectations. It's a bit of an exploratory exercise, but I do believe that the growing expat community over there, still need to invest and create multiple streams of income. So I think we can offer something out there, but it's very much seeing how the land lays over there, and I'll be looking forward to it. So
fantastic. Well, look, great to talk to you today, and we look forward to sharing this interview.
Yeah, thank you very much, David. Thank you.
The latest technical content delivered through global conversations with professionals for professionals.